Okay, we are here. We're live, and I just want to welcome everyone here today. Life's Co-Pilot is bringing you another expert panel to discuss things for the seniors. So what we have here is we've got. I just wanted to take a real quick look at somebody. But anyway, what we're going to be doing is we've got Seth Wilson, who's here with Edward Jones. We have a couple of people still waiting to come in. We've got Jamie Hopper with Money Concepts. We have Cynthia Kirstens with Mutual Omaha Mortgage. So we're going to go ahead. I'm going to introduce you guys and get this thing started. We're basically looking today on how to help that senior, their families, as they're going into these different circumstances of, aging and the different expenses that come along with it, and finding ways that we can go ahead and help them get that financing from places that other people may not be aware of. So anyway, I'm going to start with Seth, kind of give your who you are and what you do and all that kind of good stuff.
Thank you, Jim. Yes, as Jim mentioned, my name's Seth Wilson. I'm a financial advisor here with Edward Jones. We focus on goals-based planning and investment management. So what that really means is we focus work with many different clients. They're very active in their community and look to obviously generate additional income, look to plan for those life's larger goals, and quite frankly, help in retirement as well in managing those risks that are involved, especially in the current market environment. A couple of components might be something as far as mutual funds, ETFs, even stocks and bonds, but then as well, something such as an annuity, or something in between there, in addition to some long-term care insurance. So kind of a brief overview of what we do. We go a little more in depth, and it's always case by case.
Well, thank you. Robert, I see you showed up. How are you, sir? Robert Haley with AAG. I'm going to let you kind of introduce yourself and what you do. We have your sound going here?
Yeah, we got you.
Okay.
All right. Yeah, my name is Robert Haley with American Advisor Group. I'm a mortgage planning professional. Been doing it well over almost 20 some odd years there itself, bringing new wealth of knowledge there. So I definitely play in the field of reverse mortgage, conventional loans, FHA, VA there. So full suite of products itself. My whole goal is to help a client, the holistic approach for a client to better understand all the real estate, all the options they have available to them as far as they can look at their home equity program. But a lot of people don't understand how to structure something for themselves, how to take advantage of the equity home that you have available to you. So definitely look to educating, help people to leverage that to the best of their ability or know all the options available to them itself.
Well, thank you, Robert.
Mm-hmm.
Let's see. So Jamie with Money Concepts.
Yes, sir. Like Jim said, I'm Jamie Hopper with Money Concepts. My independent team and I are very passionate about helping people with retirement planning. I've kind of made it my personal mission to help people get long-term care insurance. I lost my mom 16 years ago, and I just know that if she would have had long-term care, her life would have been significantly better, and my dad would not have had 3 heart attacks trying to take care of her. So we do help people with retirement planning, retirement income planning, life insurance, selling life insurance. We do all those things. We do those well. But I've kind of made that my mission to help make sure that people protect themselves and have money when they need it. We also do help business owners with 401k plans, succession plans, things like that. But I'm really passionate about talking to seniors and making sure that they protect their assets from a major event, and more importantly, protecting their families from having to go through these things and not knowing who to talk to, and just helping them navigate through the process.
Okay, very good. Cynthia with Mutual Omaha Mortgage.
Yes. So I'm with Mutual Omaha, as Jim said, and we have a program called the Care Funding Solutions. And we are what I consider somewhat of a one-stop shop. Now, for those people that are looking to either age in place or to be involved in adult daycare, nursing home, that are looking into going into nursing home, we have a program that you can call in and we will work with you on several different funding options. As Robert mentioned, you have the home equity option. You have, there are different insurance programs out there that people may not know exist, or even nonprofit foundations that can help you or your loved ones pay for these expenses. And I just want to say, before I was involved with this company, I used to be a nurse and worked in nursing homes. And unfortunately, the experiences that I had there and what I saw, I can understand why more people want to be able and should be able to age in place. Uh, and I won't go into details unless somebody would like to ask questions. But so our program, we just make it very easy for people to call in, and we will direct you and help you ask some questions and better understand what your needs are, what the goals are, what your options are, and take it from there. But we work direct with clients and also nursing home facilities, daycare facilities, adult daycare facilities, etc. So it's a great program.
Excellent. Well, thank you very much for being here. We have one other panelist we're having some technical difficulties with, so we'll hopefully have that resolved here shortly as I'm doing things in the background while you were talking, trying to help that. So, but basically, let's kind of go into a little bit about this. You know, this getting older and the different things, the needs that come up is a very expensive proposition. So, you know, I know that, you know, Jamie and Seth, you kind of help a lot of people on the front end as well, trying to help prepare for that. I'm going to kind of pick on both of you. What can you help people do? You know, what was interesting was our own panelists before we went live. One of the questions was, when's it too late to start planning? So let's kind of start there. I think that was a really good question to start, because if we're asking that question, I imagine other people are as well. Whoever wants to take that and go.
Yeah, absolutely. I always say when it comes to long-term care insurance that the age range is between 40 and 78. Now, 40 is on the young side, but we've got different options that would help somebody plan for inflation and other things as we look forward to not needing care for 30 years. But the key is to plan ahead, because long-term care planning is it's not an asset issue, it's an income issue. Where are you going to be able to pull an extra $100,000 or more a year out of your retirement plan to be able to pay for long-term care when you need it? So the key is to get in the front of it. And right now is the best time ever to buy long-term care insurance. The industry has changed and it's improved. Now, that does not mean that it's inexpensive, but the policies are better than they've ever been before. The premiums are guaranteed. If you don't use it, it comes with a death benefit. There are all kinds of different funding options. I always say that buying long-term care insurance is like going to a bakery and buying a cake. You tell me what you want the cake to look like, what you want it to taste like, what your budget is, and we're going to create something just for you. Life insurance, long-term care insurance is exactly the same way. We're going to work with you and figure out what your needs are, what you're trying to accomplish, who you're trying to protect, what your budget is, and we're going to help create something just for you. So the key is just to really get on top of it and plan for it. If you wait too long and you have a medical diagnosis, there's not much we can do. If you wait too long and your spouse gets sick and you spend a lot of money paying for their care and you can't afford your own, there's not much we can do. So the key is to stay out in front of it and make sure you plan for that. And the younger and healthier you are when you buy insurance, the cheaper it's going to be. So the key is just to get started now and don't hesitate to ask questions. And just look at all the people around you that are going through issues. Look at your family, look at your neighbors, look at your friends that are going through long-term care issues with their families, and look at the hell they're going through. And make sure you protect your families from going through those things.
I'll echo a little bit of what Jamie said. Really what I would start with is saying the better off you are, the earlier you start planning. It's how things will finish out. So the earlier, the better. I've also typically said 40 to 70 is a good range to start planning for long-term care insurance, but I've actually here in the last year had somebody start at age 35. They went through it with their own parents and they realized the importance, and they were very healthy. So they honestly got a very lower rate, but extended it out for quite a long time. There are different products out there, and Jamie's absolutely right. The products with long-term care insurance specifically have improved drastically from where the things used to be. And there are different ways you can go about that. Typically, it's a discussion that needs to take place a little bit further to identify it, but there are some that have compounding interest on there as well that you want to make sure you utilize these buckets specifically for long-term care. There are other products where you may not be sure whether you're going to need the product or not for long-term care, and you may just want to have a safety net. where that might, one of these other products might be a better fit. It's really a further discussion to make sure to identify those, but you do want to know your health history. You want to know what your family history is there. And you want to be looking for additional alternatives there, because it is an income issue at that point, and it's one that you very much need to account for earlier to protect yourself later.
Thank you. Well, we have Tom, you're here, so welcome aboard. Tom is with Hallmark Home Mortgage. I'll let you introduce yourself and what you do. Do you hear me, Tom? Well, okay. All right, so we'll see what goes on from here. So anyway, we'll come back to Tom. If you get your stuff working here, get a hold of it. So basically, so you guys were both just saying about the, getting there, getting started early, what have you. That's a great idea. I think a lot of us get wake-up calls when we start dealing with our family members. But we need to figure out places we can bring resources in if we relate to the party. Okay, so that's also another area. And really, I want to kind of pick on Cynthia and Robert to talk a little bit about this. And when Tom gets his audio going, we'll bring him on this as well. And that is probably one of the least utilized financial tools in people's pocketbooks they can deal with. Most people have most of their assets tied up in their homes. Okay. And there's an opportunity there that you can do so much more with it than what people thought at one time. So I'm going to just basically turn this over, and Robert and Cynthia and Tom, if you can hear me, if you can get on to get your sound going, we'll get you into this conversation as well. Could you explain what today's version of a reverse mortgage is? And it's not the ones that people were freaked out about from a few years ago. So whichever one wants to start off, that's perfectly fine with me.
I'll go ahead and start, if that's okay. So with the reverse mortgage, it's just there's a lot of misconceptions and myths about the program. And that's the hardest part about our job. I'm sure Robert will contest to or attest to that. I hear all the time, oh, that's the program that takes your house. And that's just not true. We work more and more with financial advisors, educating them, insurance agents, just about creating that extra cash resource, tax-free cash resource for your clients. Just having that standby line of credit available should it be needed. So in today's market, as of recently, why advisors like this program is because, especially in a down market, when you're in retirement and you're pulling monthly from your portfolio, when you hit a bear market, that's the last time that, that's the last, the last time that you want to be pulling from that portfolio. And what the advisors will recommend is let's switch over and let's pull from your line of credit that we created until the market comes back. So that helps extend the longevity of the client's nest egg. And so by working with both programs, it just helps there to be a longer, just more money at the end, and just the money to last longer. So that's the gist of it. But I mean, there's so many advantages, especially those people in retirement that may still have a mortgage. This program is ideal for people like that because we can come in, eliminate that monthly mortgage payment, and then that increases their cash flow each month. As an example, I'm working with a client that they're going to be, by eliminating their mortgage, are saving $16,000 a year. Over 5 years, it was $80,000. 10 years, $160,000, that they've increased their cash flow by not having that monthly mortgage payment. You still own the home. It's titled in your name. You can sell anytime. Like a regular mortgage, when the time comes and you sell or you pass away, you sell the home, you pay off the mortgage balance, and the remaining equity goes to you or your estate. So, Robert? Can't hear.
Robert, can't hear you. I just unmuted you. Robert. There you
Okay,
go.
there we go. There we go. All right. I do apologize. So yeah, Cynthia hit some key points there itself, though. I think Jamie went through one of our programs where we share with a lot of the financial planners itself, help them to educate one how the reverse mortgage really work versus what they used to know. And in the down market, this is a great tool for you, allow you to do some things you want to do and make you have the cash last a lot longer. And if they have a mortgage, they say in the customer, if you want to continue to make a payment, they can still make that payment and create a line of credit for themselves as they pay down the mortgage. They create a line of credit for them as they need it. And then it's a good tool for when a person's getting ready to retire, looking at, pensions are going away. And a lot of times the house is all they have. And so how do you leverage that? Show them how to use that tool if they use it right. Not to go take the money and go and run away with it, but let that line of credit sit there and grow and use it as they need it. There's many different ways you can structure a reverse mortgage to help a client to look, whether they be there and no money at all, or those who are very affluent have funds already out there. This would be a great tool to show them how to use it in both ways and take advantage of it and still leave the house to the heirs or their estate. And that's the good thing about that. So most people have realized that the reverse mortgage is not to take your home. It just allows you to use the equity to do what you want to do. And if you pass away, you pass away, your heirs get the house. They have that up to 12 months to make a decision what they want to do with the house. We hold to help them to make that. If we sell the house for them, we pay ourselves off, and the remaining funds goes to the estate or the heirs. Misconception people have. I said it's a fantastic tool. Is it for everybody? No, but it's like no mortgage for everybody. But it's a great tool for those if you're 62 years older and looking at more ways to how to leverage the housing wealth you have. I would say look at it, get educated about it, as well as be a financial planner. It's a great tool to put in your toolbox to have it at the table with you from the beginning, give your customers another vehicle to look at and show them this option. It's not, it's going to take anything from it. It's going to help you do anything to help increase what they're doing right now and put them in a much better position.
And Jim, if you don't mind me adding, there's another program under that, the reverse mortgage. It's called the HECM for Purchase.
Mm-hmm.
And this is a program that allows people to purchase a home with a one-time down payment. And they never are required to make a mortgage payment after that. So for instance, you have a homeowner that is selling a house, they walk away with $300,000 and they go to buy another home for $300,000. They only, let's say for simplicity purposes, have to put half down, 150. And so they can then take the remaining 150 and use that as, increase their cash flow to invest, use for long-term care coverage, but it doesn't tie up all their cash assets.
Right.
And so that's another fantastic program that people, that may want to downsize when they get into retirement, definitely look into the HECM for Purchase loan program.
Right.
Cynthia, that's one I've been such a fan of for years. I've been trying to get people to use it, and it's just like people don't seem to get it. But it's like, I think it's one of the most underutilized tools that's in the financial planner market.
Right.
Yes. I just bought my house and I'm 59 and it's the only time you'll ever hear me say, I wish I was 62 because I would
Exactly. Yeah.
purchasing my house.
That's what we all say. So, man, it's a product we're too young to take advantage of, but it's a great tool to say, man, I'd love to. Hey, go buy a house, go buy my dream house.
Yes.
And never have to make a payment.
Yep.
You can buy more. A lot of times you can buy about 30% more house than you normally would afford with a reverse mortgage. It's like, wow, and get all, if you may want to do some upgrades in the house. You can do a lot of upgrades in the house. Like, hey, okay, I got the house I really want, and just live out, enjoy yourself without having to make a payment. And if they choose to make a payment, they create a line of credit for themselves.
Yes.
Exactly. Tom, can you hear me now? Tom and I have been talking privately on a chat. We're just making sure his voicemail works here, or his voice works. I don't know. Okay. So anyway, so basically, I guess, so basically we're talking about, but that's a source of money. And as you guys were just talking about it, it also then provides things like, here's an example. I had my own personal insurance guy back years ago, was talking to him about HECM for Purchase and was trying to help him figure out, how to take care of his mom. His mom was in a situation, she was in a condo that she loved, but she couldn't afford after she retired. And so she ended up fortunately having a little piece of rental property that she sold and used that money as a down payment on her condo and refinanced it with a HECM, or a reverse mortgage. And in the process, she was able to get rid of her payments. So she went from $1,500 a month to zero. She took a percentage of that savings that she had and bought a long-term care policy that was going to take care of her. You know, she bought it from her son, but she could have total care in that condo. She never has to go anywhere. It's all paid for. And I don't think very many people have any idea of all the different tools that can be used there. And this is something that all of you guys can work together on, because you know, the long-term care policy can be bought from the HECM for purchase or whatever else. So, but these are the places that I'm trying to get people to understand that they've got money they may not know they have, because money sitting in a paid up piece of real estate doesn't do you any good when you need it.
And the other thing, the thing about that too is people think that, oh, I want to leave this home for, you know, my legacy for my kids, but they don't understand that that legacy may not be there. Because if you end up going into, say, a nursing home, and what's going to pay for that nursing home expenses, but you know, your savings, your investments, the equity in your home, and by the time, you know, they could outlive their, you know, their assets. I've seen where when I worked at the nursing home, where somebody had a private room, but over the course of time they ran out of money, and then they had to move this woman into a semi-private room. And it was just so sad to see, you know, very hurt. It was very hard for her to make that transition because she really wanted her privacy, you know, while she was aging out. So, but that's what happens when you run out of money. You're at the mercy of, you know, your different facilities you'd be eligible for, whether it's a private room, semi-private room, but using the HECM program, which stands for those that may not know, Home Equity Conversion Mortgage, that it's an excellent tool to, as we mentioned, create that line of credit, you know, use that cash to do other things to further enhance your retirement. Buy the long-term care policy. Maybe if you want to leave a legacy for your kids, go buy a life insurance policy, because that's instant cash. You know, how many kids want to inherit a home anymore? You know, a lot of times you're going to have need upgrades. You're going to need improvements. You got to keep paying the taxes, the insurance until the home sells. You know, if you ask me, option to buy you know, to inherit a house or inherit a life insurance policy, instant cash, I'd go for the insurance.
And with the life insurance, just to piggyback there, that is one of the best ways to pass along money tax-free. That's a lot of people miss that part sometimes. And that just a second what Cynthia's saying there, that's a very good strategy that a lot of people do put into place there to keep in mind.
Yeah, one of the things also that people forget, for fellow realize, you bought the house for say $200,000, but there's no guarantee that tomorrow you have the house value of $200,000. What the heck reverse mortgage allows you to do is freeze that value in time right now, and then that growth rate that's on there will allow it to continue to increase over time, guaranteed, no matter what the market goes around you. In 2008, those who had a HECM at that time benefit more because the line of credit you had continued to grow, the growth rate will continue to grow, and they have money available to them down the road. And again, a lot of people say, I want to leave the house to my children. Just like Cynthia say, hey, take the cash, go buy an insurance policy and leave them that itself, you know, because you know, when you leave that house to them, you're leaving a liability to them. A lot of people don't realize that. So that's a huge liability that you get left in the house. And 99% of the time, the person you leave the house to sells the house anyway. They're not going to live in it. They're going to sell it and move on.
The other thing too I'd like to add is that for those that don't know this, you know, because a lot of times people say, well, why do a reverse mortgage, not a HELOC, home equity line of credit? But the difference is that with a HECM, this is what's called a non-recourse loan. So unlike a HELOC, you know, HELOC, they can cancel that line of credit, they can freeze it, they can reduce it, they can call it any time. And you have to make payments on that. With the HECM, you never have to make a payment on that line of credit. It can never be frozen, can't be canceled, can't be reduced. And that line of credit grows each year. So if you establish, say, for instance, a $100,000 line of credit, and you don't use it, you just let it ride. Next year, it's 106,000. 5 years, it's 142,000. It's just that line of credit continues to grow over the course of time. And you won't get that with a HELOC. So our the HECM program is just an excellent program, excellent tool. I just wish more people knew about it, understood it, considered it as part of their overall financial strategies in retirement. And it's great that more advisors, more insurance agents are really starting to open up and take a serious look at the program and are starting to utilize it on behalf of their clients.
I think a lot of times, I think a lot of people, it's, you know, there's an old saying that if electricity was introduced to the people through an electric chair, nobody would have it in their home, you know, but it was, you know, when reverse mortgages were first introduced, there was a lot of issues with them. Same thing when, you know, I always come from the building business, and heat pumps were terrible when they first came out. They're wonderful now. You know, there's all these different things. Just because what it was when it first came out doesn't mean that's what it is today. A lot of people, it's amazing to me as I've been talking to the real estate community, trying to get realtors to embrace this, how many of them think that people get foreclosed on them just because all these. Could you guys address that? Because I know that's a fear, and how safe it is today.
Yeah, reverse mortgages and foreclosures only happens like if you don't pay your property taxes now, currently today on your current home, the state's going to call it due. If you don't have insurance in your home, if you have something happen to your home, your insurance, you have no insurance in your home, I mean, you can't repair your home, you can't maintain yourself, you can't do anything with it. Reverse mortgage is very rare. The only time reverse mortgage ever somebody might got foreclosed is a rare occasion. Unless you bought a home in Florida, move down there and live down there and try to rent your house up in Indiana. But that you can't do. You got to reverse mortgage. You just got to be your primary resident. You got to remain that's got to be your home you live in. Your property taxes, you got to pay those because that's what you want to make sure that taxes are paid. Insurance, there to make sure the houses if something happens, you can take care of it. Rarely does a foreclosure happen unless you just have to do something very strange. But standard process, you still remember, you still the owner of your home. You pay your property tax, you pay your insurance, you maintain your property like you normally do. So rarely does the house get foreclosed on. So I know people think this, and if when the person passes away, the heirs have up to almost 12 months to see what they want to do with the house. And then the lender, as a lender, we work with the heirs to help them to retain their property. And when they retain their property at 95% of the value of their appraised value, not the loan value, not the balance of the loan, but the value of the home right now. So hypothetically, say that the heirs live in the house, and the values start off at being 100,000. Now it's worth, the balance is 300,000. In the market, when the heirs pass away or move out of the home, passes away, the heirs get it. And the appraised value says it's only worth 150. You buy the house back at 95% of that 150, not the 300,000 is about outstanding balance. People don't realize that's the forgiving. That's the non-recourse part. No one's coming after the estate. No one else will come to you about it. So it's a great tool. People just need to understand, educate themselves about it without preconceived notions, but really learn about it and ask questions. And every instruction of reverse mortgage, what you're trying to get accomplished. Understand your short and long-term goals with it, and structure the loan that way and what they're trying to get done. That's the best way to do it.
Robert, thanks for bringing up the non-recourse, because we're throwing that term around like we know what, because we know what it means. I promise you that not everyone knows what non-recourse means. So, that if you're upside down on the house, that you owe more on it than it's worth, you give them the keys back and it doesn't ding you in any way, shape, or form, or your heirs. That's non-recourse. Is that correct?
That's correct. Means that your balance is worth, your balance is 300,000. Now the house is only worth 150. Well, you sell the house, we take the house back, sell the house, and no one's coming after. We take whatever the house sells for, it resolves the debt. No one's coming after the estate, the heirs, no one about the outstanding balance. It goes, that's the insurance part of the loan itself takes care of that for them. And it's a great tool to protect the estate and the heirs itself, so that we can really prevent if we owe more than what the value of the home is worth. That's the key, one of the key benefits to the reverse mortgage as a whole, to the homeowner and as well as to the heirs in the estate. So you can, so if you live to be, because no one knows how long you're gonna live. It's based upon life expectancy. No one knows how long you live, because the system is set up to be based upon your age. It predicts out, but you may outlive that. You could outlive it. And I think if you went to one of plan, you can show that maybe that you may outlive the value of your home. It's a possibility, but it's also a possibility you won't. But if you do, it is there to protect you. The insurance part of it. That goes by the FHA insurance part of it.
So basically, you know, so I understand this. So say, for instance, you bought your home in 2006 for $200,000, or did your reverse mortgage as a $200,000, and then all of a sudden 2008 and 9 came, which we all went through, and all of a sudden that house is worth $150,000. You're covered. You're taken care of. Or let's say you bought your home, you know, 2 years ago, and it's worth $50,000 more in 2 years. That money goes back to you. If we sell the house, there's what the difference is between the loan balance and the proceeds goes back to the person, the heir, whatever. Is that correct?
Right, because only the lender only going to get paid back what's the outstanding balance is. That's all the lender get paid back. Anything like, say, if the balance is 150, the house now is worth 200,000. We pay us back to 150. The 50,000 goes to the heirs or the estate.
Yeah, here's something to consider, that, you know, for people that do get into a reverse mortgage at the beginning, and say over the course of time, their home just skyrocketed, you know, is worth a lot more. They can do what's called a HECM to HECM. They can refinance and then pull additional equity out of their home. So you're not stuck at that amount. You know, you always have options to, you know, come back, take a look at the value of the home and see if you have more equity available to you.
Yeah, and then we have the non-FHA jumbo reverse mortgage available for those who homes are worth million or up to $5 million. It's jumbo, that's a program available for them too. So it's a many different tools. Depending on where you are, what you're trying to do, we try to structure a loan that makes sense for you and we'll put you in the right program and show you how it works for you. You know, again, so
Speaking on that one, in fact, that's news to me. I wasn't aware there was the non-FHA ones, but I had someone explain to me one time that I thought was really interesting about people that use this that are very sophisticated. And I would imagine that when you're dealing in $1 million, you know, mortgage, you're dealing with a more sophisticated buyer. A lot of these people that are more sophisticated are using the HECM to actually do tax benefits for themselves, where they don't make the payments for a period of time. When they're getting ready to pull money out of retirement that they're required to do, they pull a big chunk out 1 year. That same year, they pay back what they have taken out in the HECM, and then all of a sudden they give themselves a line of credit and take that tax write-off against the proceeds they're taking out of retirement. Have you guys heard about that? Or
not necessarily. You know, people, they don't ever follow what you do with the money, you know.
Okay.
So that's your money. You can do with what you want. Go gamble it, invest it. So they're not really following what you do with your money. You know, it comes into play where with the financial advisors, where if they have to take an early withdrawal, and then they have some tax liabilities. What they say, rather than pulling them from your investments and having to incur those tax penalties, shift over and pull from your equity, your line of credit, where there are no tax implications.
Right. Yeah, that's working together with your financial planner itself to offset what you're doing, because the taxes is all on you pull some out of your investments, and your financial planner want to keep that money there for you to help you to sustain that growth. That if that money's doing very well, leave it there. Why touch it? You know, the financial planner gives them more money to play with for you and help you to build your portfolio much better. On the jumbo loans, those are loans of best for the more affluent person who has a house and wealth that it needs. Got $1 million house sitting there, and most people have a line of credit on their home, and they just listen to you. This way, you can take out what you need, go do what you want to do, and it's not have to make a payment unless you want to. You know, that's the good beauty of it all.
Sorry, sorry, Robert. I wasn't sure where you were. I kind of to piggyback off your scenario, Jim. It's obviously a case-by-case situation there. If you need to take some money out of your one of your IRAs or retirement accounts to go towards, and to put that towards the a little bit of the credit off of that HECM, but that's also something where we would need to make sure to be in communication with a client's CPA to make sure to juggle all of the all of the situation that would arise there. So it's one thing where we would all need to be working in conjunction and be communicating with each other to all be on the same page.
Right.
The reason I brought this up is I was talking to a CPA that was telling me that they were using this tool on a very high-end client. And the client had saved over $100,000 in taxes by doing this. So, which I thought was pretty interesting. It was brand new to me. I had not heard of people being, and when you get with some of these really sophisticated financial people, they can do some pretty sophisticated things. So yeah, I just didn't realize that tool was available. So.
There's like I said, there's a lot of different tools working with the financial planner and the CPA together, working to see how to leverage the housing wealth to the customer to best benefit them the most. That's really the key. Having all part, just like Seth said, having all this together, talking about what are you trying to do short term and long term, and which path makes better sense, and put them in that position.
Let me ask you a question, because reverse mortgages can be done in a couple of different ways. It could be done like a HECM for purchase. You just don't make payments. You can pull money out on a monthly basis. You can pull money out in a lump sum. I'm bringing Seth and Jamie into this one. Have you guys worked in partnership with some of these different people to pull that funds and to use it into the long-term care insurance policies, or to put it into, maybe if they are doing a lump sum where they all of a sudden could possibly maybe they can do more than what they're paying in interest or something? I'm just trying to figure out what kind of tools that we can pull together for people.
As far as using specifically the reverse mortgage there, I have not actually done that part. Utilized home equity line of credit previously, though, for that scenario, and it was just to be able to get help ease into a long-term care policy. So that scenario I have had arise before, not with a reverse mortgage.
Might be something to look into.
Mm-hmm.
Yes, sir. I've had a couple clients look into it, and I think it will be something we do in the future. Currently, it's for people that just haven't quite saved enough, and they're trying to figure out where they can get some extra income. And I've shown them, actually with the help of Tom, that it's going to be a good way for them to get some extra money where we can have an extra pot to help grow their money. And that way they're not taking out of the pot of money they're using for income, and they can use that extra money to help it grow and just have more confidence they're going to live the life they want to do, and the life they want to live. The issue is just finding people at the right age and knowing that they don't ever have plans to move. Because if they do move, then they're going to lose, their income source to pay for their house, and they're going to lose their home. And we don't want to have that happen, but it's a tremendous strategy. And I actually have a couple of people I'm talking to Tom with now about that. I think it's a good way to go.
Well, Tom, since we're still having technical glitches, he's been sending me messages here, so I'm going to relay for him. He says you can use the HECM line of credit to bridge to a full Social Security benefits at age 70, still retiring earlier. HECM subsidizes the income. So,
Absolutely.
So I just wanted to bring that up. So we're in a situation, again, I'm going to pick back to Jamie and to Seth here. Interest rates are next to zero. What are some different things we can do to make this work here, to generate extra income or what have you?
Well, there are a few different areas I would consider looking in. It really depends on when you're needing the income there. Obviously, we can look at bonds as a way to generate some income here. Traditionally, you would look at your savings account. You would look at CDs, whether bank CDs or brokered CDs, products of that nature. Even money market rates. Well, those are obviously not going to pay what they used to pay, or not what a lot of people that are used to higher interest rates would see. So you may want to look at a little bit more there. Another way, though, that might be a good consideration, and it really just depends on the timing of when you would need this additional income here, is potentially an annuity. That could be one way to consider looking at, especially in particular, there are fixed and variable types of annuities there that, depending on how much risk you're willing to take, it's worth a discussion to see a little bit further, but there's actually been some very impressive fixed income annuities right now that are at least worthy of your consideration.
Absolutely. The key thing is just to talk to an advisor, because you just don't know what you don't know. And people have a lot of different situations where they've been doing something for a long time and they don't know their other options. Example of that, we have a lot of people here in our area that are big into tithing, and they're getting their income checks every month and they're paying their tithe out of their income. And then we bring up the opportunity that, hey, you can pay that tithe straight out of your IRA account and that money comes out tax free. So it could be an opportunity where they're saving themselves $1,000 or $1,500 a year in taxes just by doing that. There's also something we refer to as the mutual fund tax trap, where people have non-qualified money in mutual funds. And every year at the end of the year, they get a big 1099 on their mutual fund, whether it's gone up or down or sideways based on what happens with inside that fund with the fund manager or other people in that account. And we can find them more appropriate ways to put that money into places where it still has the same diversity, but does not have the same tax consequences. And those are things people don't think about. So, it doesn't seem like a whole lot of money at one time, but $1,000 here, $1,000 there, all that money adds up. Seth talked about annuities. That's a tremendous way to get people dependable money. Another strategy that we use is getting people in funds that pay dividends. And a lot of times those are in companies that are very well established, long-running companies that have been around a long time. They're not as affected by what's happening in the economy. They're still affected, but the key is they pay that same dividend or an increasing dividend every year. And people's income stays consistent even in a year of volatility like this. And that's a tremendous strategy that we can use to help make sure people's money is protected and grows. One thing that we didn't talk about earlier, when we talked about the long-term care, is the kind of impact it could have on somebody's life. I just ran an illustration for somebody this week that they're thinking about taking $100,000 out of their IRA to fund long-term care. And what's that's going to get them $5,000 a month in monthly benefit if he needs long-term care. That's a $60,000 return on his investment every year. You can't get that anywhere else. And that's an illustration I just saw. That's for life. He's 64 years old. He's got a family that's had a long line of dementia. If he gets diagnosed with Alzheimer's and needs care for 15 or 20 years, it's going to pay him $60,000 for life. You can't get that kind of return in another investment safely. This is a guaranteed return that he's going to have for life if he chooses to take that option. And you can't get that anywhere else. Another option that we use to help people squeeze money out in retirement are Viatical Settlements. It gives people an opportunity to sell life insurance policies. We just added a great team to our business that does that. And people don't think about that option. Many people let their policies lapse because they don't think they have any options. And it's not a good way to go. And now you could even convert a term policy into a permanent policy and sell that. People have no idea that you can sell a term policy and get paid for it. The reason that's important is because people just don't realize that they have options. They get old and their needs change. They don't have kids at home anymore. Maybe their spouse died. Maybe the cash value on their policy's gone down to zero. Maybe they can't afford the premium anymore. This would give them an opportunity to look at that policy. Say, for example, the death benefit's $500,000 and you don't want it anymore. You don't need it anymore. Well, a company's going to look at you if you're over age 65 and maybe you've had a change in your health conditions. They may offer you $100,000 or $150,000 for that policy. And that's an extra $150,000 that you could use for whatever, to buy long-term care, to invest, to pay for your grandkids' college. You can do a myriad of things with that money that otherwise you would have just let the policy lapse and it would have gone away. And people just don't know that they have these options. So the key is just to talk to somebody, let them see your full portfolio, ask them the right questions, and you'll be amazed the kind of things that we could do for people just to help them find some extra money when they need it.
So people will actually buy. I've been seeing commercials on that they'll buy even term policies. So
Absolutely.
Is there kind of a rule of thumb on what the payout would be for a buyout?
There's not a rule of thumb. What happens is they go through, and our team does everything for you. It's real simple. We've got a simple application that we fill out. The only work the client really needs to do is to call their insurance company and ask for an in-force illustration, just so we can see exactly where their policy is at today. Once we have that information, we send it off to the company, they process it, and they work to find investors. And the investors actually come back and they basically make bids on your policy. And then you can go in and choose which one you think is best for you and your family. And we help them decide which one to choose or choose not to do it at all. So there's not necessarily a rule of thumb. It's kind of, it's based on their age and their health. The insurance company is betting on how long you're going to live. That's how much they charge you for the policy. And then as your needs change, your life changes, then these investors are also going to bid on your life, how long they think you're going to live. And if they think you're going to live less than the insurance company does, then they're going to make a bid on that policy. Is basically the way it works. But there are tremendous opportunities in that.
I don't know if anybody else wanted to step in on this or not. So, okay. So basically, one of the other questions back to a mortgage is this: if you can you pay off an active bankruptcy with a reverse mortgage? I just had somebody ask this question. I want to find out.
That's something that you would have to. You could settle where at closing that is something that will get paid off. That would be part of the pay, it would be a payoff.
Okay. I'm trying to figure. So I'm doing this thing where I'm trying to talk with Tom, who can't talk to us. Anyway, so hang on a second.
Just so the audience knows, I do work with Care Funding Solutions, but I'm also a HECM specialist too. That's
okay. So Tom was saying, yes, you can do that. I'm just trying to figure out what, help you get something here. So what about credit scores and things like that? So, with a HECM for purchase, people might not do it because, oh my God, my credit sucks, whatever. My income may not be high enough. So could you guys fill in some of that stuff?
If you're not making a payment, the financial assessment is going to be a little bit more lax than it would if you were having a traditional mortgage. So, and the credit score is irrelevant also. But they do want to make sure that you do have enough income that's going to take care of your taxes. You're able to pay your taxes, your insurance, and your other liabilities. For those people, they're going to look also, have you been late in your payments on your taxes or your insurance over the past 24 months? If you have, then they're going to require you to do what's called a LESA, L-E-S-A, which is a life expectancy set aside. And what that is they're going to determine how much you pay taxes, what your taxes, your insurance for 1 year, and then figure out how many years do they think you're going to live for. And then they'll set that aside. So for instance, if you had a $100,000 line of credit, but your set aside would be $40,000. That means that they're going to hold aside $40,000, make $60,000 available to you, but now they're going to make your taxes and your insurance payments on your behalf. So then now you have no mortgage, no taxes, no insurance for the remainder of your life.
Okay. I just saw here's a question I thought was a good question. Can you have, let's say for instance someone gets in a situation, they've all of a sudden got themselves in a box because they weren't paying attention to all you guys, and they got older and they had medical bills or whatever, and so they had a bankruptcy. Can they do a reverse mortgage within a year from after a bankruptcy?
You can do a reverse mortgage with a bankruptcy, but it's still going to require a LESA, and we also explain that a little more documentation with supporting documentation why you had the bankruptcy, supporting that as a whole. So it's going to require a little bit more work, a little bit more documentation to understand what happened there. And a LESA was going to be automatically placed on the home. A lot of times, when you put a LESA on someone, it almost kills the loan for themselves because they don't have enough equity to support out the tax insurance in the home itself. So you really want to make sure that if somebody's doing that, to have at least 50% or greater in equity in the house to help to offset that, knowing that it may not be no proceeds available for them to take, but the proceeds that they have available would be enough just to take care of their property taxes and homeowners insurance.
I got a message here from Tom. I am relaying for Tom here. So he says bankruptcy is a mandatory obligation. Even of Chapter 13 can be paid in full if payments have been made on time. You can even do it while you're in the middle of that bankruptcy. So I thought that was some interesting things to know, because again, it's not a credit-based loan because you're not going to be making payments on it. So it's a different.
Well, here's what you got to keep in mind, though. You always got to qualify that a payment is not required, but you can make a payment. You always want to say it's not required, but you can make payments toward that. But it's not based on your credit score, but it's based on your credit report, because it's going to look at your credit report, not your credit score, but what's on your credit report determine what the next thing. We got to be able to explain any derogatories in the last 24 months. Sometimes more underwriter's discretion, but it's just explaining everything. If something happens, we got to be explaining and documenting itself to avoid the Lisa, but also explain what happened there. So
Okay, well, I've got a question, Seth, and I was going to go back to Seth and Jamie on this one. Could you explain some of the different options that are out there when you're considering long-term care insurance, and things that are on that plate? Because I think that's an area that's not familiar to a lot of us. So.
When evaluating long-term care, first you need to sit down with somebody like myself or Jamie there and really further discuss what that actually looks like, whether you're looking at just covering for nursing home care, whether you're looking at assisted living, independent living, and those types as well, and whether it's just make sure to help with a little bit of private duty care. One of those next steps that we're going to end up taking is kind of assessing it based off of health, time frames. You think that access to this might need to be started there, but then we might look at if it's going to be dedicated specifically to specifically for long-term care. Then we need to go a process where this will make sure that it's going to be money that you're going to utilize for that, and that's not necessarily worry about getting an additional death benefit that's grown. Or odds are 1 out of 2 people are going to end up needing the long-term care itself, and so you're going to, maybe that other person may feel pretty good that they want to have it as a fail safe, but they may not want to jump right into something that's going to definitively say they need to use the money for long-term care. Well, then you might want to look at there are whole life policies with riders for long-term care that actually can be very appealing, and there's some very good ones out there that offer both options and could really kind of protect that additional growing death benefit as well. So questions to evaluate farther, it really depends on the scenario and what you're ultimately looking to accomplish.
Absolutely. You know, when I sit down with somebody, one of the first things we look at is what do we think the cost of care is going to be? And we'll look at their age, and there's a website we go to that's got a great resource, and you can just type in their zip code, and then you can also estimate farther out. So we look at what it costs today as an average in your area, and then what may, you know, if you're 50, what's it going to cost in 25 years? And it kind of estimates what those costs will be. And then we work with different products to figure out what's going to be best for them and what they need. And we've got opportunities now where you can get a joint policy with a spouse. You've got policies that will pay an unlimited benefit. And then you just have to decide, does that person think that they're going to need care for a long time? Do they think they may need care for 5 years? Do they think they may need care for 2 years? It just depends on what their family experience has been. Some people have lived with Alzheimer's and dementia and know that they've had family members that needed care for a long time. And then you'll have other people who slam their fist down and say, nobody in my family has ever needed care for more than 2 years, and that's all they want to pay for. And we've got options for both of those. And then what I usually like to do is I'll just lay out a few different scenarios. I'll say, okay, this is the Cadillac policy. This is kind of the middle of the road. These two are very good. They're going to pay long-term care benefits for a long time. If you don't use it, your family is going to get money back in a death benefit. This is a great way to go. If they look at those and they're feeling sticker shock, I've always got a third one out there, which would be a life insurance policy with a long-term care rider, which is usually a little bit less expensive, but it's still going to give them care for maybe 1 year, maybe 2 years, possibly 3 years, depending on what they're willing to pay for. And we'll just show them a few different scenarios, and then we'll start to narrow some out. I don't think this is the right one for me, so we'll eliminate that one. and we kind of work through it that way. And then after we've done that, then we can say, okay, I think this is great, I can afford this, but I want just a little bit more monthly benefit, because we don't know if they're going to need care in 5 years, or we don't know if they're going to need care in 20 years. And then depending on the policy, are we going to put inflation protection on there, or are we going to try to pay for it all up front? And there's just so many different options that Seth and I can help people find. It's just a phenomenal time to buy long-term care right now. And there's not a one size fits all. There's really something for everybody. And the strategy that I would use for this family in their 50s would be way different than the strategy I would use for a family that was 75. But they both have opportunities if they're healthy enough to get it.
Well, thank you. Hey, I am so excited. I see Tom. Tom, I'm going to let you, basically, you're going to close this bad boy out. So tell me who you are, where you are, what you do, and the stuff that's been driving you crazy you can't say.
Well, I'm a computer technology expert. Okay, I'm not that. I am a mortgage guy. I've been in the mortgage business for 47 years. I used to have a company of my own. I worked for a regional company that became part of City Mortgage, and for the last 8 or 9 years, I worked for Hallmark Home Mortgage, which is a regional company out of Fort Wayne. My specialty is reverse mortgages. I do reverse mortgages every day. I was so gratified to hear you all talking about using the HECM for home purchase. I think that's the most underutilized opportunity out there. Part of the problem is that the real estate community has not really, are not really comfortable with the process. They're comfortable with what they're used to for reverse mortgages in buying a property, but they're comfortable with traditional, but not the reverse mortgage. Most of my reverse mortgage clients for purchase come from people like Jamie and Seth, or people who have learned about reverse mortgages on their own. We often take the client to the realtor when they're interested in buying on a reverse mortgage. Great project. I worked with Jamie some, working with clients who need to do some restructuring. I think everybody in the financial planning field would agree that the equity in one's real estate is often one of the largest assets that they have. And there's limited ways of using it. We talked about doing the HELOC before, but of course we know the bank can call that. It terminates. It's going to end at a certain period of time. The HECM line of credit doesn't end. It ends when you die. So there's some big benefits there. Terrific way to get equity out, put that big asset to use, and use it for virtually anything you want.
Excellent. Well, thank you. Well, guys, it's basically getting to that time. So I'm going to do a screen share real quick because I want to do something real to introduce you to what's coming up next. At Life's Copilot, one of our goals is to basically be a resource that you can come to and learn more and more about what's available for all the different areas of the senior world. So today, we're doing this one on the 23rd. We're doing this in affiliation with the Westfield Library. We were going to be inside the library, but COVID still keeps us out. So we're going to be doing it on Zoom. But we're going to have, it's going to be places, the meet the not-for-profits and the no-fee providers for our seniors. I will be real honest with you, I don't know if a lot of people know these places and who these places are and what resources are out there. I never knew of Shepherd Center, Hand, Prime Life, Trinity Free Clinic until I had I became a board member on the Hamilton County Council on Aging. So we got Socoa that's going to be there. We have CapTel. We have Parkinson's Association. We have Morning Light, which is a free hospice for people that need that. So there's, Alzheimer's Association will be there. So that one's coming up on the 22nd. On the 28th, we have one that's been done. It's going to be on how to declutter your home and things like that. We just don't have it up on here yet. And the 13th, we have the 13th is going to be on sitting down for that family talk when, okay, mom or dad needs help and it's time to do something about it. So we're going to have that family talk and a bunch of professionals to help you go through that process. One of our members, one of our professional members of Life's Co-Pilot, is having an event, a fundraiser on the 13th. That's part of the organization with Morning Light. So anyway, I just wanted to let you guys know what's coming up next. And Life's Co-Pilot will be doing these on a couple times a month, if not more so. So thank you to all my panelists. It is 1 o'clock. I can't quite believe we actually did it really right on the button. And I thank you all so much. There will be a video coming out on this YouTube. I will be sending one to each one of my panelists and putting it out on Life's Co-Pilot. And I assume you guys will be doing stuff with it as well. But thank you very much. Anybody have anything last to say? All right. Well, thank you so much for coming. Tom, I'm so glad you got on. That's great.
All right, yes, me too.
All right. Talk to you later.
Bye, Jim.